This is my second time speaking to the University of Florida. The last time I came down here, I spoke to the MSF program, and I'll give you guys the same speech I gave to that program, which is I prefer not to flip through this presentation and go through slides. I'd much prefer having an interactive dialogue. You guys can stop me anywhere along the line. We can never start if we don't want to. I'm happy to take all questions, real estate, Gator related, fine with me. I just want everyone to have an interesting discussion, and I don't want anyone to fall asleep. So maybe I'll start with my background, if I can figure this thing out. Is it the play button? Maybe I won't start with my background.
Is it on? Let's see.
I think so.
It is on.
Will this work if I just hit the space bar or something?
Certainly.
That's good enough.
Yeah, okay. Good.
So for any of you with good eyesight, you can see I was at the University of Florida, graduated here in '97, was very fortunate to see the first national championship here in football with Danny Werfel, one of the three statues there in front of the football stadium. Had a great time here educationally and socially. It was a wonderful place to be. I had a major in marketing and economics, and really enjoyed my time here. Tried a lot of different things, a lot of different clubs and organizations, and it was really a great time to be here. After University of Florida, I had a very unconventional path to get into real estate. I graduated from here. I was a New Yorker. I went back to New York, and I figured I could just get onto Wall Street. You just kind of apply to some of these places, and you get into Goldman Sachs or Morgan Stanley. I'm a smart guy. That always happens, right? So I tried that and didn't seem to work out because I had missed the recruiting process. So luckily, I had a friend that went to Harvard, and he had given me his book of career resource recruiting contacts. And so I went through the entire book, and I sent out my resume probably to 200-300 different companies. And this was before you could email stuff. This was when you had to print up your resume on resume paper, put it in an envelope, actually lick the thing and send it out. So sore tongue later and 200 rejections later, no job. Happened to have a friend whose father was at Bankers Trust, got me a job in their back office, and even though it says New York up there, it was really in New Jersey City. Very unglamorous spot to start your career, but it was nonetheless a start. It was at a big name firm. This was a company that was bought by Deutsche Bank eventually, and it was a start. I ended up being probably one of the more aggressive guys in this position. There was, I think, 8 folks that had the same position I had, and none of them wanted to work past 5 o'clock. So I started taking on all of their back office clearing accounts for Goldman Sachs, for Morgan Stanley, for the bigger banks. They were the more intensive ones, the more demanding clients, and I was willing to put in the time to actually service them. Through that, I made some contacts, and I actually was interviewed at Goldman and worked there for about 5 years. So I started off in their kind of middle office, fixed income derivatives, swaps, trading kind of area, and eventually moved out to Los Angeles with Goldman in the private wealth management group, where I helped manage about $2 billion of assets for wealthy individuals and small institutions out there. From Goldman, I'd applied to business school, got into Columbia, luckily. Still don't know how I got in there, but I did. And went there for 2 years. And when I first started at Columbia, I was trying to figure out, well, what do I want to do with my life? So I didn't like this other stuff I had done. I wanted to be still in finance, but didn't really fully understand what product I wanted to work with. So I did a bit of soul searching. I said, well, I don't like things that are abstract, credit derivatives, and I didn't like managing other people's money because I never got attached to it. And it struck me, well, maybe real estate, maybe at least you can see that, you can point to it, you can go into the buildings, you can tell people I bought this, I built this, I did something with this building, and people understand that. So I started questioning all the folks that were in my incoming class and talking to anyone that had done anything in real estate, whether it was development, whether they'd been in construction, acquisitions, sales, leasing. And I did probably, several hundred coffees and breakfasts and drinks to get smart on what was real estate. And what do you do in real estate? What are the careers? And through that process, I figured out that kind of acquisitions was probably more my forte at the time. I thought that would be something I could add value to immediately. I understood how to run returns and how financial instruments worked, because I'd worked with some of the more complicated ones prior to business school. And so I ended up getting a job at a public REIT, a real estate investment trust called Rexon, and did a summer there, enjoyed it, and went back full-time afterwards. This job led to a massive amount of acquisitions. So from 2004 to 2006, when I was there, we were a $4 billion publicly traded REIT. And I'm happy to explain what that is if anyone doesn't understand that concept. But we were a $4 billion company, and over those 2 years, we grew to $6 billion by buying $2 billion worth of buildings. There were 3 of us in our acquisitions group. So you can imagine, if anyone here has worked in real estate before, when you buy one building, it means you've probably looked at 10 or 15 buildings to even get to the point where you could have bid and got to the final round on 1 or 2 buildings, let alone buy one. So to buy $2 billion worth of buildings, you probably looked at 30, 40, 50 billion dollars worth of buildings. So it was an intense 2 years of underwriting, but I got a really solid grounding in how do you value real estate? What matters? How do you look at leasing? What does construction cost? What happens when a tenant leaves a building? What happens when I've got a vacant space and never leases up? How do I deal with these things? So I got a really good introduction at the kind of ground level of real estate. We were a company that did development, that did construction, that did its own leasing. We were fully managed, fully operational, all internalized, everything in-house. So it was great to walk down the hallway and talk to the leasing guy. It was great to walk down the hallway and talk to the woman in charge of development. And so we got a really good grounding in terms of acquisitions and what it means to go through a process, how to negotiate documents, how to close a purchase of a building. From there, Rexon put itself in play. There were a couple offers to buy the company. It was a very hot market, 2006, and eventually they entertained a merger with a company called SL Green. SL Green's still around. They're still a publicly traded REIT. They purchased Rexon. While that process was going on, I had gone back to my business school faculty and said, look, I'm in acquisitions. I'm not the kind of guy that can just sit around and wait for 9, 12 months with nothing happening. What should I do? Who's there to talk to? What should I do next in my career? Because I'm just not going to wait. And they put me in touch with a gentleman named Marty Chico. Marty is, or was, the vice chairman of global real estate at Merrill Lynch. Merrill Lynch at the time had probably 70, 80% of the business in the public REIT space in terms of mergers and acquisitions, IPOs, secondaries, everything you do as a public company. And he was the head of it. He had just retired and was starting his own shop. So I had met him, we hit it off, and I joined him to start our own firm, our own advisory firm. It was a 3-person firm when we started, and we were doing investment banking with 3 people, which was crazy, but it was fun. We had raised capital from a lot of big names in the space that you may or may not heard of, guys like Starwood Capital, Walton Street, Lubert Adler, iStar, Vornado, Square Mile, New England Development. So all these folks ponied up a little bit of capital to get us going and to start our advisory shop. And the deal was they put in some capital, they owned a piece of us, and they throw us some advisory work to get us going, and then we'd be up, running, operational, and we'd grow from there. And so we did this for about 3 years, and unfortunately, the market kind of turned 2008 on us when we were right in the swing of things. We had just completed $1.8 billion sale of apartments for a company called UDR. We'd sold it to a private equity shop called DRA Advisors. It was a great deal for 3 guys and a computer. All the other investment banks were up in arms, all the other brokerage shops up in arms as to how we got the business, how did we get to do that as a 3-person shop that nobody had really heard of. And that carried us through the downturn. We started getting phone calls on restructuring assignments as the world turned in 2008. as folks were going through bankruptcy or considering it, as leverage levels got through the roof, as companies were in trouble. And we quickly realized that we were having a hard time winning mandates because as 3 people, you can't do that business. You need to partner with massive shops. You need teams of people. You need 10s and 20s of people to comb through documents, to do these sophisticated transactions that are experts in this, that do this all the time and only do this. And so we started partnering with some other shops to try to win assignments, and it never really was quite cohesive enough. We never really seemed like we were one firm. Everyone kind of realized we were 2 groups joining together, and it never really worked out properly. So I'd introduced Marty, who I worked for, to the CEO of Evercore at the time. We had a bunch of discussions and eventually sold the business to Evercore. Evercore did not have a real estate group at the time, so we merged into them to start the real estate group. And we've grown now. We were 3 people when we joined. Better part of 4 years later, we're now approximately 9 people in our group, and I think by the end of the year, we'll probably be 12 people in our group. So it's been a pretty big growth from 3 people, computer, to now part of a massive institution, which we can talk about. But before we do that, anyone want to talk about anything that I mentioned already? Mm-hmm. So restructuring involves a lot of knowledge of the inner workings of debt documents, bankruptcy rules, and understanding the different methodologies of how to work your way out of situations where the equity may not be worth anything. How to deal with other constituents and other parties that may or may not have leverage either financially or legally over you. And that really is an in-depth and complicated world, and the documents for even one piece of debt are that big. When you get into these situations where there's 15, 20, 30, 100 pieces of debt, then all of a sudden you have to have someone that's been through it, knows what to look for, has worked with the right legal teams before, and can actually help you through all that, and then can tell you how it plays out, how a court would probably rule if you were to go one direction or another, who will generally win, and you need a lot of experience to understand that and to know what is likely to happen and then plot your course accordingly. So it ends up being a good team because what they don't know, what the restructuring guys don't know, is the value. They don't understand, because they haven't worked in enough, how is real estate valued. So that's where the team kind of comes in, where we understand the company, the assets, the value, and then they understand, well, okay, when you roll all that up, what happens and who has the fulcrum security, who's got the leverage, who can do what to whom based on the input of what the value is. That's kind of how you work together on that. So, give you a little introduction to Evercore. When I joined Evercore in 2010, I think we were 350 employees. I think now it says approximately 1,000. I think that's dated. I think we're closer to 1,200 employees. So we've had a massive growth. That's over the course of 4 years. We have 475 M&A and restructuring professionals. And I think that number is light, the 6 advisory professionals from University of Florida, because we've got 2 more that are with us now. So we've had a strong connection to the University of Florida, and we've had a strong connection to Wall Street, and we've been growing tremendously in an industry that has not really been growing. So there's been this trend in the advisory world to move from the bulge brackets, the Goldman Sachs, the JP Morgans, the Morgan Stanleys, to the more independent advisory shops, or sometimes called the boutique investment banking shops. And the reason why is that at a shop like Evercore, you can give unconflicted independent advice and not have any stake in the client. So if I'm at a JP Morgan or a Morgan Stanley, I may make loans, and I may very well have a loan on a business that I'm advising to do something else. And so there's an inherent conflict there. Evercore can, and the other banks that are like Evercore, can go out there and say, we are unconflicted, we don't make loans, we don't have a balance sheet, we don't make equity purchases, so we are completely unconflicted, completely independent. And for that reason, the shops like Evercore have been gaining market share, and I think there'll be a slide on that in a minute. And so a lot of the top professionals from the other bulge brackets have been saying, well, that's where I want to go. I want to be giving advisory work. I want to be doing things where I can add value. I don't want to be doing commoditized type of work where I get brought into a deal because I've got a lending platform and because a company that's merging with another company needs a loan, therefore my mergers and acquisitions group gets brought in. With Evercore, that's not the case because we don't do that lending piece. In addition to investment banking, we have capital markets, investment management, research, and we're a publicly traded company. The capital markets and institutional equities, just to give you a flavor, is a group that we have that does trading, but it's trading on the behalf of clients. So it's not positions that we take with Evercore's balance sheet, it's positions that we're trading on behalf of our institutional investor clients. And why do they trade through us? Well, they trade through us because we have a good research team. So our REIT team, I think has about 20 professionals now, covers about 25 different publicly traded stocks, is very highly regarded on Wall Street, and therefore the institutions that invest in REITs value the research and then they'll place trades through our trading desk. Our equities desk also is there so we can do secondaries, we can advise on IPOs and actually be co-managers and advisors on those deals. So it opens up a whole host of new business for us because REITs, as some of you probably know, are in the perpetual capital raise business, right? They distribute a majority of their income, and if they want to grow, they have to do something. They have to borrow or they have to raise capital in the public markets. And that's where we can make another fee stream because quite often what happens is we'll advise a public REIT and a transaction won't happen. We have no way to make a fee there. They valued our advice, they valued our time, and then when they go and do an equity raise, they'll say, we'd love to have you involved as a co-manager, and you'll receive a fee through that vehicle. So it's a important leg of the stool when you're in the advisory business to be able to do stuff both on the advisory side for transactions and also on the equity offering side. And then the investment management business, I think we'll probably get to that as we get forward, but I think we manage about 16 billion of assets. None of it is real estate. Yeah, this is all about why Evercore is so wonderful. We can probably skip that. But we've advised on a lot of the largest transactions. I think we were involved in the largest transaction for 3 of the 4 past years. So as a smaller shop, it's quite unusual to be that high profile. We're pretty global. We've got offices in, as you can see on the map, the U.S., Canada, Brazil, Argentina, Spain, London, across the board. The yellow ones are affiliates that we have, so we don't own those entities, but we have exclusive arrangements with them to do cross-border transactions. Because at the moment, it's just not efficient to have a fully built-out team in India or in China. We're still figuring out the market, figuring out what works there, and how to best play there. Nothing? Anyone? Questions? Comments? Country anyone likes? The firm was founded by Roger Altman. Roger Altman was Deputy Secretary of Treasury. He was the Vice Chairman of Blackstone, one of the first folks at Blackstone, and the co-head of investment banking at Lehman Brothers. A few years ago, we brought on Ralph Schlostein, always a tough name to say, but he was the co-founder and president of BlackRock. So 2 big name folks at the top of our shop, brings a lot of press releases and a lot of notoriety. Ralph was really charged when he joined our shop of trying to smooth out our income because 90% of our revenue comes from the investment banking advisory business. And as you can probably imagine, good times, bad times, neutral times, that fee stream is very lumpy. You do big deals, there's waves of time where you don't do as many big deals. Ralph had a big background in asset management, and so he was charged with increasing our AUM, our assets under management, so that we can have a constant fee stream coming in to neutralize the lumpiness of the advisory business. And then Eduardo was the chairman of global investment banking at Citigroup, and he's one of the heads of investment banking at Evercore. This is the stat that I was talking about before, or the concept I was talking about before. On the left, you can see, 14 years ago, the large investment banks had almost the entire market share of M&A deals going on in the world. Now, the latest trends show you that the independent firms have almost 20% of the business, which is a staggering improvement if you're looking at CAGRs and the like. But when you think about what I was saying, it's very consistent with what the stats show you. And this just gives you a flavor for where we sit in the world and who we're kind of compared to. So, on the left, you'll see those are kind of the top independent firms, and we've outpaced over the last 3 years, and I think over the last 10 or 12 years, all of those banks on the left in terms of amount of deals that we've worked on that have been announced and closed. And then you can see on the right, we're slowly creeping up amongst the bulge brackets that have, on average, 5 to 10 times the amount of staff we have in every group.
Now that the asset management business has been around a little longer, how much of the income now is generated from that?
I think we're currently at about 90% from advisory business. So that business has been growing, but not growing tremendously fast, because the way you have to grow that business is, one, by capital raise, but two, by acquisition. And we've been very, very calculated about acquisition, because it's a tricky world. In that business, typically the owners of the asset management businesses make money by the assets they manage, and they typically don't like to sell. They like to keep that fee stream, and so it's hard to pick them off and have them fold in. If you buy too much of their business, they're not incentivized to grow their own business. If you buy too little of it, it didn't mean enough to Evercore. And so it's a very tricky situation to find the right acquisitions to do calculated and to buy enough of and keep the guys motivated in those businesses. Mm-hmm.
You mentioned that a lot of people want to work for you all because conflict there.
Mm-hmm.
Is there certain companies that want corporate sales just about everything in the world?
So, if I heard the question right, you're saying you understand why professionals want to come work at the company, and the question is why would a company hire us knowing that we don't have the capability to loan or things? So, the reason why we'll get hired is for the two things that we have, which is our time and our advice, right? That's all we have to offer. And because we have some of the top professionals across the board in all the different industries we cover, we'll get hired for the best advice, but we'll also get hired because the client knows that there's no conflicting agenda that we have. So they don't have to worry that we're telling them they should refinance a piece of debt because we own the debt and we want to get out of it, or anything along those lines, or advising a merger because we've got a big loan on the target that they're going to buy, and it's going to help us, get that loan from out of the money to into the money. They know that there are none of those agendas. Our agenda is solely good advice to you as the client. Now, on the flip side, to be quite frank with you, there's some business we just won't get because some people need that loan and they want to go to the house that will give them the loan, and then they'll hire that same place to be their advisor. So it's a bit of a dual-edged sword, but we prefer to be in that situation where we can look at a client and put our hand on our heart and say, we're here to completely give you good advice and nothing else. Our growth? I think we've been, versus all firms or versus the independent firms? Last 12 months, I'm not sure actually. Let me see if that's the next slide. There you go. That's our fee growth. I think we're happy in the top 10. I mean, just because of the size disparity, to be in the same conversation with them is really where we aspire to be. We want to be at the top of that independent list. That's where we want to, and we've been there on any metric, on any given period of time, on last 12 months, last 3 years, last 10 years. We've been up there as number 1 or 2, depending on how you calculate it. But we'll show you the way we calculate it, which is number one. Someone over there, but go ahead.
Statistics are really interesting.
Mhm.
But perhaps share with us your experience,
Oh, sure. Yeah, I'm going to get there actually, but it's good. That's what I'd prefer to talk about. This is really just the background on who the company is, and then probably in 2-3 minutes, the next section will give you a flavor for who our group is, the transactions we worked on. We can go through some case studies of actual deals we've worked on. That's the kind of stuff you want to talk about?
yeah, like what you've seen, what you've done,
Mhm.
both on the positive side and the negative side.
Absolutely, yeah. If you table that for 5 or 10 minutes, we'll get there and we'll talk about that exactly. Anyone else before we start getting there? Go ahead. Probably our energy group out of Houston. They've grown like mad, and that's been probably the most active sector in all of banking for the last 3 years. At first, it was inorganic growth. Yeah, it was acquisition, and then it's become through hiring. But the most senior professionals have come from other shops. And Ray Strong, who's one of the professionals there, I think he was at our firm for 4 days when he made his first announcement of a deal. Like a record. So this just gives you a flavor for the Evercore growth, which I think was a part of a question from earlier. And of course, the way we show it, our growth is a lot higher than everyone else's in terms of revenue. And this just gives you a flavor again for the size of deals that we're working on, and it's right up there with all the other guys that were in the large institutions bucket. So you can see we're playing in that game. We're just not staffed the same, so we're not doing the same amount of transactions as them. We just don't have the same staffing, but we're working on the same deals. As a matter of fact, I think we're working on larger deals than most of the bigger banks, on average. These are just some of the deals that the firm has worked on across industries. You can see some of the big names you probably recognize from the papers, whether it was the Dell deal, which was kind of hotly contested, or Kraft and Kinder Morgan, and then going back to the McGraw-Hill days, from a couple of years ago. Same thing. These are just a list of deals, and we'll get to that second deal up there, which will answer part of your question of things that I've liked or not liked, or things that have been interesting, which is the Westfield deal and its sale of a few $1 billion of shopping malls to Starwood. Anyway, bunch of wonderful transactions. So now I'll get to the good stuff. So this is the real estate group. This is the stuff that my group does. We do everything from mergers to strategic alternatives and IPOs, roll-ups, private equity investments, capital raises, portfolio sales, restructuring. So every day is different. Every deal is different. Some deals include multiple ones of these, and it's been across the different property types. So we've touched everything from multifamily to industrial to office to medical office to student housing. It's been across the board, across industry types. These are some of the most recent deals we worked on. The one on the top left there, we can talk about a little bit. This was a very interesting deal, talking about the form that real estate's held in. This deal, where we advised the state of Michigan retirement system through one of their entities called Domain, was they owned a position in a company called Edens. Edens was a private shopping center company. They own Class A assets, very highly regarded, mostly East Coast type of stuff. And Michigan was the first investor in Edens. Later on, J.P. Morgan and New York State Common Fund, State Teachers Retirement System, came in and were investors. Michigan, 2 years ago, said, you know what, the market's getting hot again. It's time to go public. This is going to be really well received. We should go public, and we should sell this business. J.P. Morgan owned this asset in an open-ended fund. Open-ended funds are funds that do not have a life to them, right? And so when you manage an open-ended fund, your goal is to continue to grow it. You don't want to sell things unless you have something else to buy. because then you have a hard time maintaining your yield, maintaining your dividend, maintaining your investors. So there became an inherent conflict here between the motivations of JP Morgan and Neisters, who was being advised by JP Morgan, and the state of Michigan retirement system. So we got hired by Michigan to figure out, what do we do? We want out, our partner doesn't. How do we get through this? We spent the better part of a year working with everybody, trying to bring in an investor, trying to see if there was a way to force a sale, seeing what all the documents kind of allowed you to do. You were very restricted as to who you could talk to, what types of transactions were allowed without a majority vote. And there was a period in time called the sunset provision where at the end of this year, the company kind of disbanded. So everybody had this kind of smoking gun hanging out, and it was kind of the prisoner's dilemma that everyone learns at the beginning of business school, where if you get to that box on the decision matrix, I think everybody is a high probability of losing, whereas you can choose any of the other boxes, and at least somebody's doing all right. We were able to bring in Blackstone to come in and say they'd be happy to buy out the state of Michigan for $718 million and put in additional capital to help this entity grow. So therefore, JP Morgan wins, right? They get to be in an entity that continues, that owns still owns the same assets and can grow, and Michigan was able to get out. So this was a case where it wasn't all about the real estate. The real estate drove the value. This is all about the form and the substance of what kind of transaction can you actually execute to get everybody happy, right? And the negotiating point was always about the value of the real estate, because one side of this transaction is trying to beat down the value, right, and say, well, you should be bought out for $600 million, right? And maybe we'll do it as JP Morgan, whereas Michigan's saying, well, the value is $800 million because I want to be bought out at the maximum price possible. So the underlying part of this whole negotiation is the value of the real estate, but the way the transaction really went down was finding somebody that could appease to both sides. So it was an interesting mix of a little bit of game theory and a little bit of value. So, I mean, the true value is what someone pays for it. At least that's been my experience, right? Because everyone can argue why something's worth more or less, but until someone buys it from you, the value is never really discovered. So this was probably right in the zone of what Michigan wanted to get paid, probably a little bit higher than what they might have accepted. It was also a higher price than JP Morgan was willing to pay to buy out the state of Michigan. So there wasn't a meeting of the minds. There was no price at which JP Morgan would have bought out state of Michigan that state of Michigan would have been okay being bought out. So by bringing in the third party, you were able to bridge the gap. That makes sense? Or? So if you and I were negotiating and you wanted to sell me a pen and I said, I'll buy it for 10 bucks, and you say it's worth 11, and someone else was willing to come in and pay 11 bucks, you know, you'd be happy with that, right?
Yeah, I guess that's what I mean. Is the value the overall market value, or is it just what I think it is and you think it is?
It was all based on numbers and cap rates and the value of the real estate. And we did a ground-up analysis of every single asset and the cash flows. And I mean, this was it wasn't just like throwing a number at a wall and hoping it was right kind of thing. It was these numbers were pretty grounded. To put the money in, to actually do the transaction. It's definitely not over email. And the lock in the room concept doesn't happen that often either, although it would be much better. We always offer that up and it never seems to be taken up. But yeah, I would love for that to happen. No, the way this went down was definitely a lot of posturing, a lot of back and forth, a lot of, the head guys from one side saying, we don't want to negotiate, we'll just wait till the end. We're fine with that sunset provision hitting. We're fine with this getting to the end. And same thing with the other side saying, we're fine with that happening too. And for certain, neither of them want that to happen. And then you're waiting for one guy to crack just a little bit and say, well, maybe we'll talk, And eventually, you know, with the advisors in the middle between us and Domain and some of the others, we were able to save face for both clients by saying, well, I'm not saying my client would do this, but maybe we should talk about this, right? So that's not really coming from them, it's coming from the advisor. And that quite often is the advisor's role, is playing a little bit of the matchmaker, a little bit of the middleman, a little bit of the peacemaker on transactions like this where there's no budging for a period of time. So a lot of times that's the deniability, the air cover, whatever term you want to use from the client side can be given through an advisor. So, yep. So Caesars, unfortunately, I didn't do too much on that one. That was more done through a few other groups. But the long story short here was Caesars was in financial trouble, and the ultimate transaction here was they spun off part of their business. They spun off the profitable side of their business and left kind of the bad assets in another entity to be worked out in a restructuring. And so this is probably a good 6 to 12 months of negotiating. TPG and Apollo, I think, were involved in here, so it became a pretty heavy negotiation as to what assets leave, who owns what of which entity at the end. But that was, beyond that, I'd have to bring in someone else to give you a little more flavor on that one. I'd say if you look over the course of 10 years, it's probably 5 to 10 clients that you see show up quite often. But in terms of on an every year basis, there is no necessarily recurring business. Now, when you pair this advisory work with the equity offerings business, then you'll see some repeatability, which as we get through this a little more, you'll see. But it's low, the amount of companies or clients that are doing business every year at a significant level. Mm-hmm. Sure. So maybe, how do I go back if I go forward here? Do you guys, is it just the back arrow? Oh, nice. All right, so let's do this. So for Westfield, does everybody know Westfield or what Westfield is? Yeah. Some people nod, some knows. All right, so Westfield is a multinational owner and operator of malls. They started out as a developer, grew into a massive portfolio, and at one point they were in Australia, New Zealand, the UK, and America. Ever since they've been changing their business a little bit. They're doing things like they're developing the World Trade Center site. There's a large mall going up where the Trade Center used to reside and where there's big development going on now. So they do marquee, Class A located shopping malls. They and Simon kind of go at it as the two biggest in the world. They sold off about half of their Australian business, and they're trying to sell the other half now into the entity that was created to buy the first half. They're also paring down a good chunk of their business by getting rid of their non-core assets, or what we're calling their B malls. So they own a bunch of malls, or they did at least, in places like Omaha, Nebraska. Great, viable shopping mall, fortress kind of shopping mall where everybody that lives there goes, buys all their stuff. But not a sexy mall, not a place that if you don't live in Nebraska, you say, oh, I have to own that mall if I'm buying malls. But nonetheless, a good, stable, slowly growing property and business. So they hired us, Westfield, in 2011 and said, look, we'd love to sell a few $1 billion of these non-core malls. And we said, that's great. That's a great piece of business. Thrilled to do it. And they said, but here's the thing. There's no one to buy them. Right? There's 2 or 3 public companies that could actually buy them. They don't want them. And we probably don't want to do a deal with them. So we'd like to hire you to create a buyer and to set up a process. And we said, all right, well, how do you do that? How do you create a buyer? How do you run a process where there's no one logical to buy it? And we spent a lot of time thinking about that and structuring internally or coming up with structuring thoughts internally. And what ended up happening was we were able to pitch this to a bunch of the larger private equity shops and say, look, you're not in this business right now. You can't own malls. Malls are an oligopolistic business, right? It's the same tenants in every mall you go into. Now, some of them have a couple of the high-end anchors, some of them don't, some of them have slightly nicer shops, but every mall you go into has a Gap, right? Every mall you go into has a Banana Republic. So there's some synergies, unlike a lot of other real estate, in owning malls, and therefore there are very few owners in scale of shopping malls. So when you go out and pitch this to people and say, buying one mall is not a good idea, right? You're never going to be able to compete with all the other owners and operators of malls. Why does a good shop want to be in your B mall? They'll be in a Westfield B mall because Westfield says, if you want to be in my A mall, you got to be in my B mall, right? And they can negotiate like that, whereas you can't if you own one mall. So we came out and we said to groups like Starwood Capital and a few others, here's an opportunity. Why don't you set up a business here where you can buy a bunch of malls from Westfield, own a few billion of these things, a few $1 billion worth of malls, and you could be the B player in the mall space, right? We can give you scale day one. You can increase your assets under management, which is, by the way, one of the most important things to a private equity shop, and put you in a totally different business. It doesn't compete with all of your other capital. You'll be able to go and raise additional capital for this side business. Could be a good idea. Most of the shops said, that's good. We don't understand the business. I don't know. And we had, some sovereign wealth funds that said they'd be interested in doing it, but they didn't have an operator. This isn't the kind of property type that just has a ton of people out there that know how to run a mall. Lots of people can run a strip center. Lots of people can run an office, an industrial building. But a shopping mall is a really specialized set of tenants. It's a very specialized entity. And there just aren't that many, because of the oligopolistic nature of it, there aren't that many folks that are hanging around that aren't in the business already. So we were able to really give the Dare to Be Great speech to Starwood to say, why don't you start up this business? We'll hold still, which is a concept we've learned has worked recently in real estate and other banking, which is we'll keep a product, whether it's a bunch of shopping malls or something else, off the market for a period of time, and we'll allow you, private equity investor, to go raise capital around the strategy, and you can tell all those investors, you have the exclusive right to buy this. But you only have a period of time to go do that, right? We'll stop a process. We'll allow you to go do that, because we think you have the ability to go and raise that capital. And Starwood is someone that we've had a long relationship with. It's run by Barry Sternlicht, who's pretty famous in real estate circles and has been doing this for a long time, and is one of the few people that can go out and raise $1 billion in 2 or 3 months. And so we did that. We held still on several malls to them for Starwood, and after a long, arduous negotiations, we were able to actually complete that sale. They then contracted out with CBL, who is a public REIT, to manage it while they started building up their management team. And now they are able to manage, own, operate malls themselves. Since they got themselves up and running, we were able to do another transaction with them near the end of last year. So now in that entity, they've got $2.7, $2.8 billion worth of Westfield malls. They've also bought, I think, 5 or 6 other malls from Macerich and some other companies. So they've created now a viable B mall opportunity that they can raise capital around. Yeah, so that was the Westfield deal, and then this O'Connor deal was also, these were non-core malls, all in Florida actually, where they raised capital from O'Connor, another good relationship of ours, to buy 49% of it. This is for tax reasons, and I could bore you guys with that some other time, but that was also part of the strategy. But you can see, over the course of from June 2012 through November 2013, Westfield was able to kind of get out of, let's call that 700 million, $1.7 billion, so $3.3, $3.4 billion worth of malls when there was no market that existed to sell it into. Mm-hmm.
I saw something in the paper talking about business that was in the retail market in the States out there.
Mm-hmm.
Is that something your clients are worrying about in the retail market?
I haven't seen that, because what's happened is there hasn't been a lot of retail development, which is always a good indicator of when things get a little bit too hot and heavy with supply and demand, right? So even though that's been sort of the common convention for a little while, development has kind of gone away a bit for retail, and that's allowed demand to catch up to the supply. So I still think good locations, good tenants, they're still going at extremely low cap rates right now. It's the stuff that's in the secondary markets and not the best location in the secondary market where a grocer is leaving and the shopping center is dying. And so a lot of people now, the trend has been to only invest in strip centers, for example, that have the number one grocer in the market. If it's a number 2, 3, 4 grocer in the market, investors don't want to play because they think that it could die. There's not demand for it. So I guess we can go back to where we were just to give you the final piece of our group, and then we can talk about, if you guys want to talk about, I've got a few more of those kind of case studies that we can go through to talk about some deals we worked on. But just to give you the quick run through here, and we can talk about any of these as well. So we talked about the Westfield ones. We've been advising Iron Mountain also. This is a company that's trying to convert to a REIT, and the IRS has kind of put the brakes on that a little bit over the past year or so. They set up a special committee last summer and told everyone that applied to convert to a REIT, you got to wait a little bit. We're looking through this and we'll come back to you later. So we've been in there, and if they ever get the go-ahead to convert to a REIT, we're going to have a bunch of advisory work with them to help them get through the conversion from a C Corp to a REIT. The landmark transactions are also, my partner Greg has been doing those transactions, but this is a consolidator of the B space multifamily assets, and they took over a REIT. Then they raised capital from iStar and Blackstone as preferred capital, and they're now out there pounding the pavement to do either a public offering or to do further acquisitions. And then one deal that's really interesting, this Morgan Stanley deal, was the reason why we got that state of Michigan business for the Edens deal we initially talked about. Morgan Stanley, talk about like some conflicts of interest and why that matters and why we get hired for not being conflicted. Morgan Stanley had this entity called the Special Situations Fund. And Special Situations Fund was a minority, international, non-controlling, private equity open-ended fund. Only one of its kind. And by minority, I mean they own minority interests in operating entities. So they had raised about $3 or $4 billion into this. At their peak, they were $8 or $9 billion of total asset value. And Morgan Stanley owned 25% of this fund. And they had raised money from all the big shops, including Adia, who I understand Tom Arnold was here not too long ago, but it was a different side of his shop that invested. So they were 25% of this fund, and then the Volcker rules came out and said, guess what, as a bank, we're not okay with you guys owning so much of the private equity anymore. You guys have to trim down your balance sheets. We have to de-risk banks. We're not going to have another crisis like we had a few years ago. So Morgan Stanley said, all right, you know what? We're going to take this open-ended fund that has an infinite life to it, and we're going to make it close-ended. We're not going to invest any more out of it in it. And as these investments ripen and we sell them, the fund will wind down. We'll be out. We'll comply with Volcker rules, and that's great. And they pitched that to their investors, and their investors said, whoa, the only reason why we went into this was A, you're invested heavily in it, and B, it's the only open-ended international minority investment fund out there. Once you change this to close-end, it doesn't suit the needs that we have anymore. And so it became a bit of a standstill. So what do you do? Morgan Stanley's worried that all these investors in this, which included the state of Michigan, the state of Washington, state of California, Adia, Otic, who works a lot with Adia, and the list went on and on. It was a roster of the highest profile investors. They're invested across Morgan Stanley. They do tons of business, in fixed income and in currencies and across the board. And Morgan Stanley's saying, well, I don't want to upset all these guys over this when there's a whole host of other business we do with them, but I need to get out. What do I do? So we got hired to sit in the middle of this and figure out what's the right transaction. How do you solve the real estate and structural needs of these investors, but also appease to Morgan Stanley's regulatory needs and the inherent conflict that's now coming up here. And we were able to structure a deal, talk about negotiations. This was trying to get 20 people from institutions that only work, 5-6 hours a day on different time zones, all to agree to a phone call a week. Finding the time for that phone call took us 3 weeks. 3 weeks to pick a time that we could regularly schedule a conference call, and to deal with all the issues that were going to come up here. So we were able to structure a deal here where the management of this entity was able to leave Morgan Stanley, create their own entity, and sub-advise this entity. So they were still managing this entity that was housed at Morgan Stanley. We were able to close-end the fund, so it had a finite life to it. And as the investments ripened and were sold, the money would then flow to this new third-party manager. Morgan Stanley would reduce its interest. The investors would keep their interest. It would still appear open-ended to them because they've got this new entity that's got a life to it, and they still had their exposure to the old assets. And these guys are now in business with their own fully funded private equity shop that was viable and made some money. And so this deal, that deal took the better part of 6 to 8 months to negotiate the terms, the fees, how it worked, who was staying in, who was going to roll their money, who wasn't, who had to go back to their investment committee to make sure that this transaction actually worked for them, who could get on these phone calls to actually say yes or no every week to everything we were doing. But we were able to work that out and create a unique structure where everybody was pretty happy. So in my mind, this was one of the more interesting real estate transactions that happened last year, or real estate related at least transactions. And to give you a flavor, this entity owned everything from a company in Australia that owned office buildings, in prime locations, to a Chinese developer of residential land, to a piece of the Hilton debt. So they own a little bit of everything. They own motels in Mexico. They owned rest stops in Germany. So this was it was a little piece of everything that really required specialized management. You need to keep the same guys on board, and I think we were able to come up with a pretty unique structure here that worked for everybody. So just a few other examples, and then we can go in depth if you guys want on any particular deal again. But C-Vest was a sale of medical office buildings, and this also interesting transaction. So when you are in private equity, you're a smaller fund, you operate $330 million in medical office buildings. What do you do? What do you do if you no longer manage assets? So you sell that fund, you make your promote, you make a little bit of money, and now you have no assets, but you still have 30, 40 people working for you. How do you pay those people, right? Prior to that sale, you were making fees for managing these assets, right? And for having the assets under management. And so those fees presumably covered the salaries and the overhead and the rent and all of the operating expenses you have. But you sell all your assets, how do you pay for everybody? How do you keep your business going, right? And the answer is you have to raise more capital. So, or you have to go away. It's one or the other, or you have to come out of your pocket and pay everybody. So in this transaction, C-Vest had originally come to us and said, these funds are going to ripen in the next few years, and we're starting to raise our third fund, but we're not having much luck. We're not raising enough capital. Can you guys help us figure out, is there a strategic investor? Would somebody want to come in here, give us $100 million, $50 million? We've got a great track record. We've done so well with these medical office buildings. They're all next to prime hospitals. We bought them at the right time. We've been doing a great job leasing them up. We're wonderful. And we combed through their financials. We looked at everything, and we said to them, you have been doing a wonderful job, but your track record is unrealized. Right? You bought all this stuff, and you're telling everyone it's worth a lot more than what you sold it at, but no one's bought it from you. So is that really a track record, right? The answer is no. Until someone buys that from you, you can't say it's a realized track record. It's an unrealized track record. That's the point. So the whole point here is that they were saying they have a great unrealized track record, and we said you can't raise off of an unrealized track record. You've got to realize a track record. You have to sell the assets, otherwise you don't have a track record. And in this world, in this institutional capital raising world, most large institutions will not give capital to first-time funds, and you're deemed a first-time fund until you have a realized track record. So you've actually sold assets, you've bought them, sold them, and showed you made money. So we went back to them and said, we know you want to raise money. Why don't you sell everything you own right now? And they said, well, how are we going to pay for all of our employees? We can't do that. We can't just give up all our fees and do that. And we said, that's how you're going to raise your money, right? We spoke to a bunch of sovereign wealth funds and Canadian funds and institutions, and they all gave us the same feedback. These guys don't have a realized track record. It seems wonderful. They're good guys, great business, like the industry. Not going to do it. So we told them that, and they didn't like that. They didn't like that concept. They didn't like the risk involved with selling this and hoping it worked out. And we told them, look, if you really did that good of a job and were able to sell this for such a profit, won't some of your current investors want to invest in the next fund, right? So that'll be good. And then we'll be able to attract new investors, and ultimately you'll probably win out. You'll have realized track record on your first two funds, you'll have made some money, and you'll be able to manage the same amount of money in your next fund. And eventually we were able to convince them that that was probably the right strategy to explore. We did a marketing process, and sure enough, yeah, when we found Duke, who's a publicly traded company in the medical office space and trying to grow in the medical office space, who was going to pay $330 million for this, they said, all right, well, that's good. That's good pricing, and we like that. But we're still worried about what we're going to do between the sale of this and then whenever we can raise the next bit of capital. And we were able to negotiate that Duke would keep on Seavest as a manager for 5 years and pay them a management fee that was equal to what they were receiving as fees from their funds. So therefore, they had this runway for 5 years to keep paying their employees, paying their rent, keep their business going, and bridge the gap between sale of all their assets and then ramp up of their next fund. And so we were able to bridge the gap, complete the transaction, and everybody kind of won in the transaction. So in this case, it was great that they told us it was worth something, but it wasn't worth it until we were able to sell it. And that's the price it was worth, $332 million. Same kind of concept we were talking about before, where we can debate what something's worth, but until someone actually puts money down and pays for it, don't really know what it's worth. So in my mind, that was one of the more interesting transactions, one of the more fun things to work on, and one of the more real issues that people have to deal with, that's beyond just the do a good job with the real estate. This is what happens to the entity that owns the real estate? How do they go on? This type of advice has been some of the stuff that's been the hardest to have buy-in for, but has turned out the best, where it's, I know your goal is X, but we should do Y, and then X will happen. So, there was another deal we did, which it's earlier on, but it was the same company, UDR. They're a publicly traded company, and they were trading, in the bottom third of their publicly traded comp set. And they were just annoyed. They thought they had better assets than that, and they weren't getting the respect they deserved from the institutional community. And they came to us and said, what do we do? How are we going to trade better than this? I keep telling everyone how good my assets are, and everyone says, yeah, and then we trade here. What do we do? And together we came up with the concept of, maybe you sell the bottom third of your portfolio, you prove where the value is, right? When someone buys it, you prove where the value of that bottom third is. Everyone else will know the rest of it was worth more. You'll have a better set of assets, and potentially you'll trade at a higher multiple. And we went through this for a little while, and they agreed, and we did that sale. They reinvested in some other assets, made a special dividend, did some seller financing, and sure enough, they moved up from the top of that bottom third now to the kind of middle, bottom of the middle third. And that's where they've kind of stayed now. So it's another one of these where the initial advice seems slightly counterintuitive, but when you realize that it's one step in a two-step process, and you can actually get your mind past, I don't love the first step, but I like where it gets me, that kind of advice has been, I think, the hardest to give people, and also the most well-received after thought out for long enough. The stuff that hasn't been well-received is what I've been kind of pontificating for a long time, which is, I think the opportunity right now is buying B assets and B markets right now, across the board. There's no bid for it. There are very few buyers for it. Lots of sellers of that stuff. And no one seems to want to take me up on it. You might be the first. Blackstone, look, Blackstone has actually been executing that strategy for a period of time now, but they're playing, at a very high level. There's opportunities in the $300, $500 million, $1 billion space. You don't have to do that in $2, $3, $4, $5 billion chunks. But there really is very little bid for that product. Yeah, so interestingly enough, I think the reverse is what I found. So I think that the private equity shops, in my mind, have had more medium to short-term expectations because they've got finite life to their funds. And so if you catch them at the very beginning of their fund, then they have 5, 7, maybe 9 if you're really aggressive year horizons. But they're trying to make returns that if they hold things for 9 years don't work. So they're typically looking in this 5-year horizon. And as you get a couple years into their fund, well, that 9, the longest end of that, goes down to 7 and 6 years. So I found that they've been a lot more short-term than the REITs, because REITs, and the public vehicles should be more long-term in thinking. They're not generally rewarded for buying, fixing, selling. They're generally rewarded for buying, fixing, holding. And so I found that the REITs typically tend to have they're more predisposed to having long-term or perpetual capital, whereas the private equity shops are always thinking about, how do I get out of this? I get how I get into it, how do I get out of it? What are my exit options? They're always thinking about that, where the REITs are not, the public guys at least, are not generally saying, how am I going to get out of this? They're thinking about, how do I hold this for a long time? How does it fit into my portfolio? How does it gel with the long-term strategy that I'm pitching to the market? They're thinking more about that, at least the good ones are. Yeah, so we were representing, and this is still going on, we were representing an owner-operator of industrial assets. And these are also A, located, but B, structural real estate. So they came to us and said, we'd love to bring in somebody that would come in and buy into 50% of our company, recapitalize out our current partner, and then give us additional capital to go buy more assets. So it's a platform play. And we said, that sounds like a great idea. And so we went out, we looked for capital for them, and we found a lot of folks that said, I'd love to buy their existing assets. And we found some folks that said, oh, I'd love to do acquisitions with them. And we didn't find anyone that said, I'd love to buy their existing assets and do acquisitions with them. And what we slowly learned, we knew it ahead of time a little bit, but we thought it might have been different today. What we slowly learned was it's very hard to negotiate against and with the same person. Because in that way, when someone's buying into what you currently own, you're negotiating against them, right? You want the highest value, they want the lowest value to buy in. And then on the other side of it, you're negotiating together to buy the next assets. And it's two different parties that generally like to do that. The ones that will do both, unfortunately, are the highest cost of capital, and it's not what this client wanted. He already had that guy in his capital structure. So it was good enough product. It was the right time. We thought that where these assets were was a pretty hot market, and we thought we might have been able to thread the needle. The company was best in class and a pleasure to work with, and we said, what, we'll give it a shot. This is a bit of a thread the needle exercise, but let's give it a shot. And we failed. We weren't able to do that. We actually tomorrow get in indications, though, on probably a third of their portfolio, which we think will actually trade. And then the next challenge will be, okay, how do you find the next guy to co-invest with that capital that's left in the business to buy the next slug assets? So while it was a failure in terms of getting the one-stop shop, I think ultimately it'll be a successful execution. It's just going to take longer, and it's going to be two different parties. Yeah. Sometimes you do that. Sometimes you take on assignments because you think that it's a unique circumstance that, although it usually doesn't work, maybe it works this time. And in our business, because we're only 8 full-time people in our group, we have to be very careful about choosing assignments that have good people, smart folks, businesses we believe in, and transactions we think can happen. Because we run into a big problem if we're choosing too many of the ones that transactions don't happen. Because we don't have the luxury of massive group that we can just be working on 100 different things at once and hope a couple of them stick. It's not the way we're structured. So it's one of the most important things we do is choosing our client. And we've been fortunate enough to have enough opportunities that we don't have to take on everything that comes to us as an opportunity. We can actually have our daily, bi-daily, whatever it is, meetings and discuss it amongst myself, my other partner, and Marty, who runs the group. Is it worth doing this? Is this assignment good? Do we like those people? Are they going to be a real nuisance to work with? Are they going to be a pleasure to work with? This is a new business line that maybe we can do a repetitive transaction and use this experience and do it for the next person. Is it something that's fun? Is it something that's likely to happen? Like, that's the stuff we think about all the time. All the time. Marginally. No. So generally, the way we get paid is on a transaction happening. We do get retainer fees at times, but those are usually reserved for situations where we think that may or may not lead to a transaction, but someone just needs advice. And there are certain cases where the client says, I don't want you to be biased to giving me advice that leads to a transaction. I want just advice, right? And if you're motivated in terms of a retainer, then you're motivated just to give straight up advice, right? I'm not saying we would choose the route of telling someone to do a transaction if it wasn't the right thing to do. But in the mind of a client, that can be thought of as, so if you're not going to get paid for telling me to do nothing, but you're going to get paid for telling me to do something, aren't you going to tell me to do something? So in those rare situations, we'll take a retainer fee. And we'll often say we'll offset whatever retainer fee it is against the transaction fee anyway. So that way it doesn't really matter to us either way. But usually it's on a transaction happening. So whether it is a capital raise, a sale of a business, public offering, a merger, any of the things we talked about, that's generally how we get paid. I wish it was just for being there, just for showing up. That would be awesome. Look, the other way we get paid, which is what I talked about maybe closer to the beginning of this, is through our capital markets desk, right? So quite often we'll run a process, we'll give advice, no transaction happens, and our client really just loves what we did for them, the way we help them think through things. They know we'll do business again together, and then they say, you know what, I'm going to go buy 20 buildings and I need to go raise $300 million in the public markets. And they say, Evercore, you guys were wonderful in our last assignment. We'd love you to be a 10% co-manager in that deal, right? And that way we get paid something for that transaction. Those are very high margin, very low time spent type of assignments. So it's another method for us to get paid for time spent on things that didn't happen. We love that business. I'd love to exclusively be in that business where people just call me up and say, I want to pay you. And on that note, I mean, look, these are just some of the IPOs that we've been involved in. We've actually created an interesting position in IPOs. So talking about conflicted advice, in an initial public offering, an investment banker typically underwrites a company, right? Takes that company through a process where it helps it get itself from where it is to looking good for institutions to invest in it, and then ultimately has to go build a book of institutional demand and then sell that business to the public. Well, because we don't do IPO underwriting, we've come out and said, we'd love to be advisors to people that are going to go through an IPO. We'd love to come in, help you, company A, and say, who are you going to hire? Who are the bankers you're going to hire to run this process? You know, do you know if JP Morgan's better than Bank of America for this particular process? You know, do you know who knows the most retail investors? Who knows more institutional investors? Who's going to give you the best advice, right? We'll come in, we've done enough of this that we can come in and say, we'll help you do that. We'll help you run that process. We'll help you pick the bankers you use. We'll help you get ready for being public. We'll help you translate what they're telling you and how much of it you really have to do, what you really should focus on, what they're just saying to you because it makes their life easier, things along those lines. And then at the ultimate end of the process, when the bankers come to you and say, okay, today's the day we're going public, and the public, there's enough demand to buy your shares at 20 bucks, but you wanted to sell it at $21, $22, what are you going to do? We can be there to say, you know what, you should take that deal or you should not take that deal. Or you know what, here's the information we should be asking for from those bankers to make that decision. They don't need to just tell you that on a phone call. You should be able to see the book of demand. You should be able to see the numbers and understand whether or not to make that decision a yes or a no. So we've built a nice little role where on a bunch of these different IPOs, we held that role. And we were able to advise a company that had never gone through a public offering before as to what they really needed to do and what advice they could actually trust and not trust from the bankers on the other side. Because there is this moment in time, at the very end of an initial public offering, where you have to wonder, is the banker telling me that this deal should be taken because he's more worried about what the institutions think, because they're his clients too, or what I think? Whereas we can sit there and say, we're not even on the institutional side, we're just advising you. We're telling you what to do. We have nothing to do with those institutional investors. They're not clients of ours, they're not part of our business, we're just helping you figure out what you should do. So on most of these, we've done that, and we actually helped create with our Mexican entity a public market in Mexico. So a few years ago, there were no public REITs in Mexico. Legislation changed. We were the first to the game, and we've taken, I think, now 3 or 4 companies in Mexico public, and they're called FIBRAs, and they're structured very similarly to U.S. REITs. And it's become, you know, a massive institutional raising business now in Mexico. So this Fibra Uno is just that. It was the first one, and hence called Fibra Uno, and that was March 2011. And then since, there's a few other, there's the Fibra Hotels and Fibra Danhos, and that market has really kind of exploded and become very viable for pension funds and institutional investors to actually transparently invest in Mexican real estate. There's 2 ways to get paid on those. One is it can be just a flat fee. You know, so there are these things called structuring fees when you do IPOs. So generally the lead book managers and the guys that are running the process get paid proportionally more than the guys that are in the next line of the IPO and than the marginal banks. We'll typically up front just negotiate a fee that is a percentage of the deal. So it's, at times we get shifted to be calling a senior co-manager or get paid through that side. And times we get paid a structuring fee, which is taken out of the margin of the entire deal. So therefore the co-managers and everyone get paid a little bit less because we got paid something. But the client doesn't pay any more. They still pay the same amount. Yeah, it's a dicey proposition as to how to do it, you know. And exactly, for them it's great. Mm-hmm. And this is just the team and our wonderful picture. So that was Marty who runs our group, and then there's myself and Greg who are the managing directors, and our 2 associates and 2 analysts. I think, what do we have, about 10 more minutes? So a couple things we can, yeah, I'd much rather go through questions. And Yeah, look, I mean, CMBS has been pretty active the past 2 years, the better part of the past 2 years. So yeah, I mean, CMBS is definitely an active part of the capital stack, you know, and for better or worse, most of the work out of the old CMBS kind of happened and worked out okay. You know, there's another wave coming. You know, 2017 will be some of the 10-year debt, but at this point, the markets have been so good the last few years for REITs that there shouldn't be an issue refinancing that, barring some kind of setback over the next year or two. You know, the 5-year debt, we're way past, or we're, I guess, at the very tail end of that mark. And then the 7-year debt also, that's kind of been more, so yeah, the kind of the past is the past now there. There's very short-term memory, I think, amongst the bigger banks that do that. I think that it's a little bit less structured than it used to be. You know, they're not taking CMBS and then putting pieces of it in CDOs and then taking CDOs and putting it in pieces of CDOs. And I think that's kind of stopped a bit, but the CMBS world is definitely alive and well. Mm-hmm. So I wish I knew what would happen the next 6 months to a year for sure. I'd make a ton of money. It seems to me that, so what we talked about yesterday a little bit, if I remember right, is that, you know, when interest rates make big gyrations, either go up a lot or go down a lot, it affects the banking business. It affects real estate, and it affects the real estate banking business. Either of them generate a lot of transaction, right? Whether if interest rates are going down a lot, there's a lot of purchasing going on, and then there's a lot of M&A going on. As interest rates tick up, some people get into trouble, and then the restructuring world, you know, comes into play a bit. But if interest rates go up, you know, slowly and steadily, as long as the economy is growing, as long as other things appropriate for interest rates to go up are happening, our business is marginally affected, I think. You know, I love to see, you know, good growth, good times, interest rates going up, you know, in lockstep with the economy growing, I think is a good thing and a good sign for our business, and growth is always good for our business. It's these wild gyrations, while they create a lot of transactions, they also create a lot of uncertainty, and in times of uncertainty, there's not a lot of transactions that happen. What do I think about it? I personally think they'll be around. I mean, I think it's hard to replace that. I know there's been a lot of talk about it, and I could be dead wrong on that, but I think that's a massive undertaking, and the lending world relies on that a lot. I mean, the multifamily space in particular. I think it's very hard to recreate it. I think it's a flawed concept, but it's there. And changing what's there for something that's not there is very hard, especially when it's politically oriented, I think. So I should clarify your statement. You know, we don't raise capital for our own benefit, and we don't invest, right? We're strictly advisory. So when I'm talking to investors to give money, it's usually for a product or for a company I'm advising, or I'm working on behalf of the investor that's trying to put out the capital and trying to find product for them. So, yeah, I mean, in that respect, we are completely. I mean, that's one way to look at it. Yeah. It's a constant job, right? I'm always talking to the largest investors. I'm always talking to people in the real estate space, whether it's the public CEOs, whether it's you know, significant owners of private companies, because a lot of times it's about knowing what somebody wants to do, and then when you find out someone else that wants to do it, partnering them up, which is, yeah, in its simplest sense, brokering, right? But once you're out of the information flow, you're kind of dead in my business. You have to be relevant, you have to be current, and you have to continually be in front of people. And you have to have them call you too. You can't always be the one calling them to find out what happens. When you really want to make it in my business, you have to have people that want to call you to tell you they want to do something. That's the biggest difference between someone that's successful and not successful in my business. good advice, track record, experience, and part of it is hustle, right? Part of it's me being in front of them enough that they say, you know what, I want to give that guy a chance, right? So it's a little bit of all that stuff, or a lot of some of that stuff. Yeah, exactly, exactly.
How did you transition from sports to
So, when you are at the more junior levels in our business, the real key is to be able to get through analysis, but then understand what you're producing. What does the analysis mean? So I ran an IRR, but what does that mean to whatever process we're running or whatever thing we're investigating? And until you get to that point, you can't really be speaking to clients because you can't explain what you've been working on. Once you do get to that point and you can start speaking to clients, you generally are speaking to folks that are lower down. You're not talking to the chairman of the board. You're not talking to the CEO. You're talking to the folks that are actually doing the real physical work at those companies. And as you grow in your career, those folks are also moving up, right? And so who may have been the CIO the last time you talked to them now might be the CEO of another company, or may have stepped up to be the CFO of that company. Or the person that was the CFO you're talking to now is the CEO of a different company. And so that's how you're kind of end up progressing from the support, the analysis, the understanding of the analysis, the speaking to the lower level folks of the companies to actually knowing the decision makers. Once you know the decision makers, that's when you can start generating business. Because it's very hard to call someone that's lower down in a company and have them make a decision to do a deal, right? You can tell them your idea and they can say, okay, I'll run it by so-and-so. Much better for you to be able to call so-and-so and talk to them about your idea. So that's where it starts to switch, but it's a process. You have to first do the analysis, understand the analysis, explain it to someone else, right? Then be able to direct other people to do the analysis, then be able to take all that and be able to look through different applications of that analysis, different transactions that may work, then know your client as to which ones they would never do, and then be able to actually pitch that to your clients. So that's kind of in a nutshell, the progression of it. And that all happens 35 hours a week. So. Anyone else? I think the Westfield and the Morgan Stanley ones were interesting. The most interesting, the one fact though, which is beyond the case studies, that I think is really interesting, is this right here. The first bullet and sub bullet. Everyone talks about real estate, and real estate's massive. It's everywhere, right? We're in a piece of real estate right here, and then everyone thinks this public real estate world is so big, but take a look at this. The total equity market cap, when we did this presentation of the real estate world is 670 billion, right? Look at the size of Google, AT&T, and GE. Those three companies together are larger than the entire public market for REITs. Those three companies, right? So what's very interesting, is that real estate is still a very private business. Real estate's huge, but most of it is held in the private hands. So this public world we've talked a lot about today, and a lot of things that we do is just a very small fraction of this business. So you have to be in front of the private owners, the private developers, and that's where the real action happens. It's not where the real action happens that you read about in the papers, because it's not public and they do things quietly and they have no need to be in the papers. But it's a big business. So REITs. Here it is. REITs own 10 to 15% of the total institutionally owned commercial real estate. 10 to 15%. Right? And they're doing transactions that are 3, 5, 10 billion at a clip. Yeah, exactly. It's probably smaller than that. I'd say it's probably like 5% maybe. So it's a massive world of real estate, and what we talked about today, a lot of it is just this little sliver of that massive world. So there's plenty of opportunity to do stuff that has nothing to do with the public world and all the mumbo jumbo and all the disclosures and filings and all the things you have to comb through in my world. And we deal a lot with this. We deal a lot with the private guys, and I think real estate's a fascinating business, and there's always opportunities. And you know, if you want to make a ton of money, I think you should go buy B assets and B markets. And most of that's not owned by these guys. It's owned by private individuals. So.
Well, perhaps we should again take it off the hook here. I'm sitting here thinking, for 2 years we had this new lecture series, and motivation of it is to open the academic visit, so you can see the real world unit of extraordinary.
Thanks.